Welcome to our YouTube live event, and we are live right now from the NFCC, and we're really looking forward to this conversation about Credit 101 and improving your credit score. We've got some great experts on the line with us for some Q&A, and one of the things that we're going to be doing is giving you an opportunity, you the viewers, an opportunity to ask some questions of your own, and then our experts who are on our panel we'll be able to answer those at the end of some of the formal question period that we have scheduled. Anytime during this broadcast, you can enter your questions in the YouTube live chat box at any time during this video stream, and then we'll have those questions at the end to be able to address in the order that they came through. So as you think of a question, don't hesitate, plug in, type it into the chat box. But before you get to that, I want to make sure you also pop into the chat box right now just to say hello and let us know you're here. And as you join in, you can pop a comment in just to say hi. And by doing that, you're not just letting us know that you're in the audience, you're also registering yourself for the chance at winning a prize. So if you say hello to us in the chat box, you could be chosen as one of the winners of our $25 gift card. So we'll pick one winner for that, and you're putting your name in the hat just by saying hello. So good luck with that, and welcome to this video stream. Now I'm going to give our experts a chance to introduce themselves, and then we'll get started with some questions. So we'll start with Kim. Kim, say hello to the audience and tell us a little bit about yourself.
Sure. First of all, thank you for having me today. I'm very excited to be part of this. My name is Kim Cole. I am the Community Engagement Manager for Navicore Solutions. Navicore Solutions is a NFCC agency. We are a nonprofit financial counseling organization, been in business 27 years.
Thank you, Kim. And now we have Rod Griffin. Rod, tell us a little bit about yourself.
Hi, Bruce. I'm glad to be here. I'm Rod Griffin, Director of Consumer Education and Awareness for Experian. And most people know us as one of the big three credit reporting companies, but the world's largest information services provider, we like to think of ourselves. But love to be part of the program. Appreciate the chance and look forward to answering people's questions and talking about credit, as always.
Well, it's great to have you here, Rod, and Kim, you as well. And again, we've got a lot of questions to get to, and there's so much to talk about when you talk about credit scores. There's also the credit report, the different factors that go into the credit scores, what's the most important factor, what people should be doing, what they can and can't have access to when it comes to their credit score. But Kim, I'd like to start with you. Just a very basic question. This might be more appropriate for some of our younger viewers. But what is credit and how old do you need to be to get it?
Okay, so what is credit? Credit essentially is when a lender, maybe a bank or someone who basically gives you money that you are then able to use to purchase goods and services. And then you have to pay back pay that money back to that lender, usually with interest. And actually, the question of when you can obtain credit is interesting. It is basically the age of 18 is when you can get you can sign a contract, but for a credit card, it's actually 21. So if you are under the age of 21 or between the ages of 18 and 21, you need to either have a parent that can co-sign for you, or you have to be able to show that you are financially independent and stable enough to be able to afford that credit card.
Yeah, and I imagine there are probably a lot of people that are asking, especially parents, if they can skirt around that a little bit, if they can get their kids started on credit at a younger age. Rod, is that possible?
Yeah. Yes, Bruce, I definitely can. It's simply a matter of adding them as a co-signer or being a co-signer for a loan, or adding them as an authorized user or a joint account holder for one of your existing accounts. So you can get around that, and it's not uncommon for parents to do that to help, say, a 17, 18-year-old, sometimes younger, begin to establish a credit history and have it there to work for them as they become young adults.
Well, and one thing too, and I guess I can throw this to both of you as a second follow-up to the first question. When it comes to credit, and especially younger people just getting started, you just can't go and qualify for anything. So where is the best place to start for young people?
So
Rod?
you want me? Okay. I was like, I'll jump in. So what we just mentioned, so if you are a parent, you may want to add your minor as an authorized user to one of your existing accounts. That can be a great way to help them start a credit history, simply because as an authorized user, they have no responsibility for that debt. So if as the primary account holder, you become late on those payments, it won't affect your child. They can have that authorized user account removed from their credit history. So it's a pretty low risk thing to do. An alternative would be something like a secured account with a credit union or a bank, where the child actually opens a savings account, which is a good thing in and of itself, and then learns to use that account that's associated with that savings.
But with the authorized user option, isn't there a danger then to the primary account holder? Let's just flip that scenario around, and let's say that their kid just goes nuts and charges, buys a small private island with the credit card. That puts the primary card holder in the position of liability.
Yes. Yeah, there's always risk of having an authorized user on your account, or being a co-signer, or having a joint account, because that other individual might abuse that privilege. If it's a child, you have an advantage. You don't have to give them the card. So you say, yes, you're an authorized user, but you can't have it. So you could protect yourself a little bit in that way, potentially.
Okay. Kim, any thoughts?
I totally agree with Rod. One of the things that I recommend when it comes to the authorized user too is make it a credit card with a small credit limit. So that if the kid does decide to hook it up to their Amazon account or whatever the case may be, they can only go so crazy with it. We're also advocates of secured credit cards as well. However, buyer beware. When getting involved with a secured credit card, you always want to make sure that you read the fine print, make sure that they are indeed reporting to the credit bureaus, and watch the fees associated with them as well, which is why getting it through your bank or your credit union is usually a good starting place.
Yeah, that's a good point about a couple of things you mentioned there. The fees, number one, and number two, that not all of these options for credit building may be reporting at all or on a regular basis to the major credit reporting agencies. And there is no law requiring a creditor to report. Is that correct?
That is correct.
Yeah. So good things to look out for. Well, I'm going to move on to our next question, and I'll go to Rod first on this. But how is a credit score calculated, Rod?
Sure. A credit score simply represents the information in your credit report. So there are lots and lots of credit scores. They all look at the same things. Are you paying your bills on time? So late payments are going to hurt your credit scores. Are your balances on your credit cards high as compared to the limits? Typically above 30% is considered very negative. The lower, the better. And then they look at what's your mix of credit. How have you used credit over time? How long is your credit history? What have you done recently? Say the last 3 to 6 months or so. Have you opened new accounts? Have you increased your balances? Have you applied for new credit? What have you done there? Are you trying to take on a lot of new credit? Have you done good things or bad things? And then they'll look at the rest, sort of your capacity, kind of the remainder of that score. What kind of outstanding balances do you have in installment loans, those sorts of things. So it's really all about paying your bills on time, keeping your balances low on your credit cards. But they all look at your credit report. Take care of the credit report, you'll have good credit scores.
Okay. Kim, any other advice for people in terms of how the score is calculated and what people should look out for?
I think it really is critical to understand that on-time monthly payment really is the key to that credit score. When we look at the different factors and the percentages in which each area is weighed, that on-time monthly payment carries the heaviest weight.
Yeah.
I'd also like to point out, I know we'll probably get to this, but the score, while it's indicative of what's on the credit report really is the critical piece of the puzzle. The score kind of gives you an overview, but that report really is the critical piece.
Mm-hmm. And one thing to point out too, there are many different scoring models out there. There's not just one. A lot of people will refer to Vantage Score or to FICO, but there are other scoring models as well. So I guess in the bigger picture, I know we talked about the things that are the most important factors in your credit score. I'll throw this back to you, Rod. Is that applicable to all scoring models, or is that just applicable to a few?
Yeah, that's true for all of them. And the FICO and Vantage Score are scoring companies, and you don't just have one FICO score or just one Vantage Score. So there's at least 4 different Vantage Score models out there. There are maybe 60 different FICO scores, so scores for auto lending and mortgage lending and credit unions and you name it. And they're all a little different. And so they use them depending on their particular need. And so it's important to know there are different scales as well. So you really can't compare one number to another. I always tell people, be careful when you get 2 different credit scores. They probably will be different. They probably mean the same thing, and that's what's important.
Yeah, and that's a good segue into our next question. I want to direct this to you, Kim. What is a good credit score?
What is a good credit score? So if we take a look at kind of the basic FICO, the Fair Isaac Company model, it's kind of a tough question, but our judgment is good credit starts somewhere around 680. And that ranges up to somewhere around the 750 range. Once you get above that 750 range, you are in the excellent credit category. But I like to see my clients 680 and above. I think that's where they'll be able to obtain credit and where we start to look at a kind of a good quote unquote credit.
Okay. And to follow up on that question, and this is for you, Rod, do you think there's a risk of over obsessing about the minutia of your credit score? I mean, where should people be on this? Should I be checking my credit score every 5 minutes to see where it is? And should I panic if it drops a point or?
Yeah. No, if you did that, you'll have more gray hair than I do. Yeah, you still have some. I'm still clinging to mine barely. But yeah, people do. They obsess over this number, right? And as Kim said, it's the credit report that's really important. The score just represents the information in that credit report. So I obsess over my credit report. I don't worry so much about the scores. It's good to know what they are if you're planning to apply for credit. It's certainly important to check them, know where you are, use them as a tool. But the way I described it is if you're in school, you write a paper, that's like the credit report. The teacher assigns a grade, that's like the credit score. So you take care of the paper, you're going to have a good grade. If you take care of the credit report, you're going to have good credit scores. And it's common sense stuff. There's no real trick or secret to having good scores. As we talked about, Kim said, and you said you pay your bills on time every time. Mm-hmm. Everything else kind of falls in behind that. Keep the balances on your cards low. You're going to do fine. So don't obsess over the number. Obsess over the credit report.
Good advice. Good advice. And I'll put the next question to you, Rod. Give me some examples of why a credit score is important. Like, what is a credit score going to allow me to do? What is a good credit score going to allow me to do? And what is a bad credit score going to prevent me from doing?
Sure. So we all know about the kinds of common things. I want to get a credit card. I want to get a loan. The lenders are going to look at the credit score. It's the tool they use to analyze that information in the report and determine whether you're a good credit risk. Things we may not think about. If we all have a cell phone or a smartphone, the cell phone provider might look at your credit report when you say, hey, I want that $1,000 telephone, to see if you can actually pay the bill for that service every month, so they can check your credit score for utility service. When you're applying for gas, natural gas or electricity, they might look at a credit score to determine whether or not you need to pay security deposits or installation fees. Going to rent that apartment, they'll check a credit score to see if you qualify. So it's not just credit these days. There are lots of other reasons that scores may be considered. So you need to take care of that report and the score. So very important.
Mm-hmm. And Kim, do you have anything to add here?
Now, I think Rod really kind of hit the nail on the head here. We're living in a society now where your credit score is almost being used as a judgment tool. So, almost like a character tool. So, we're seeing insurance companies, we're seeing employers, people that.
I'll correct you on that one, though. Employers don't get credit scores.
Right.
They don't get credit
That's a huge myth. That's a huge myth. So
They get the report.
Yeah,
score.
they get scores.
Yeah.
Okay, so we just want to make sure that by maintaining that good credit, you're not leaving yourself out of being able to, get the phone service, get the utility service, rent the apartment. Those are all critical.
Yeah. And with a low credit score, you also, if you do qualify for a loan, you're going to pay maximum. So that low score is going to cost you a lot until you're able to restore your score to where you would get more affordable lines of credit.
There's a great calculator that I've used in doing some programs with the military in a presentation, and I think it's at credit.com actually, but it's a lifetime cost of credit calculator. And when you look at people with great scores, you can put your information in. And over the course of a lifetime, if you look at auto loan, mortgage loan, credit card balance and averages, the difference between having really strong scores and really poor scores could be a house. I mean, in terms of the cost, it can be hundreds of thousands of dollars in some cases. So
yeah, so that is incentive enough if you have a low score to strive to improve your score to where you can qualify for more affordable lines of credit. Just the savings, the overall savings itself. So that's a good point. I want to go now to you, Rod, and talk about where consumers can get a copy of their credit report and how often they should check it. The second part I'm really interested in hearing in terms of your what advice you have for people who want to check their credit report, but where can they go to get it?
Yeah, get a free report from each of the 3 national credit reporting companies once every 12 months. So it's not calendar year, it's every 12 months at annualcreditreport.com, www.annualcreditreport.com. It's very easy to do. You'll go into that website. There's some good education material there too. Say I want Experian credit report, or I want TransUnion, or I want Equifax. It will put you into their system, get that free report. So it's once every 12 months. So how often should you check it? At least once a year. Yeah, it's free at least once a year. You can also get a free report if you're unemployed and seeking employment, if you've had a declination letter or what we call adverse action notice, meaning you didn't get the best terms. So you get a free report that was used. So if you're a victim of fraud, you can get multiple reports. So the ways to get lots of free reports. Check it at least 3 to 6 months before you apply for major credit opportunity. So if you're buying a car, buying a house, give yourself at least 3 to 6 months to know where you are, so that if you need to take some action, there's time for that information to be updated. Fraud, those sorts of things, once a year may be enough. If you're, one of those people that's really concerned, you can subscribe to a monitoring service and you might check it all the time. But, don't obsess over the number. That's like we said, if you've just made a change. One thing, I had this question the other day. Somebody said, I made a change and paid off an account and I checked my credit score and I went down. And my first response was, you should have given at least a month, because there's time for that to stabilize. You may see your scores go up and down a little bit. Don't panic about that. That's a natural kind of thing. You should see it trend upward, but you may see dips. So don't check it all the time, because it's like the stock market and it will just freak you out.
Yeah, that's good advice. And I would, one of the things that we hear sometimes in terms of questions about checking the credit report, people will often ask, well, I heard that checking my own credit report creates an inquiry and then it'll send my score down. But that's a myth, right?
Yeah, the answer is yes, but no. Yes, it will create an inquiry, but it's what we call a soft inquiry. So it's a record that someone's looked at the report. You're the only person who ever sees that. So it doesn't affect scores. Don't have to worry about that at all.
Well, keeping along the same track of things that cause your credit score to go down, Kim, give me some examples, because you and the counselors there at Navicore, they see a lot of specific scenarios where people had good credit and they got in trouble and they fell behind. So what are the things that can cause your credit to decline?
First and foremost would be late payments. When you're 30, 60, 90 days late, that's immediately going to start the ball rolling, unfortunately downward. So again, it would be late payments. It would be situations where you're driving your debt up close to the credit limits. So when people start to get desperate and they start charging and they get real close to their credit limits, that can have a negative impact. So that those are two of the areas that we see that unfortunately causes the biggest credit hits.
Yeah, and so with that in mind, what are some of the things, the leading stress points that people are saying they have right now? I mean, we talk about the different changes in the economy. There are a lot of trends right now. People are adding their credit card balances are increasing. We've seen some reports that show for certain segments, delinquency rates are going up. What are some of the financial stress points that are causing that right now?
That's a good question. We're definitely seeing an influx in people that are struggling with credit card debt. Again, we're seeing balances higher than we have in quite a while, and I think that combined with increased student loan debts, I think that is a key point. I think the fact that car prices are higher now than they've ever been. So I think the cost of living in its own right is stretching people pretty thin, and access to credit became easier over the last few years. And it's driving, people are driving the balances up just to make ends meet. I think it's kind of the age-old tale.
Yeah. Well, we already covered a little bit about how people can start with credit earlier. So I'm going to jump ahead. And Rod, this next question is for you. How can somebody, I guess if you had a misstep and you fell behind and your credit score is now at the bottom of the scale, what's some quick advice for somebody who can to bring their score back up?
Yeah, and I always recommend that you get your credit score and get the risk factors that go with it, because the number is nice to know. You'll know where you stand. If we're talking about somebody who's had some problems, it's going to be low. But the risk factors will tell you exactly what from your credit report most affected that score and what you need to work on. So everybody's unique. There are about 220 million people with credit reports. They're all a little bit different. So knowing that precise information helps. So I'm always cautious to say, do this, but I will anyway. So what you have to do is pay your bills on time. So if you've fallen behind, which is the most common cause, as Kim's pointed out, and we talked about, you fall behind on your payments, you have to bring them current, catch up on those payments. Reduce your credit card balance is also a great point that Kim made, that we're seeing balances increase. You have to bring those balances down, get them below 30% as a starting point. The lower, the better. That really applies to everybody. And those are the most common issues that we see. Yeah.
Okay. Kim, do you have anything to add there?
No, actually, I think Rod said it perfectly. That's, I think the one thing that people need to understand is that there's no quick fix. I get that a lot where, I want to buy a house tomorrow. My credit score is X and I need to get it up by 200 points. Rod had mentioned earlier that you should really pull your credit report at least 6 months before making a large purchase to kind of see where you're at, because they're really, it takes a little bit of time to kind of mess up the credit. It's going to take a little bit of time to fix the credit too. Mm-hmm.
Well, it probably takes less time to mess it up than it does to fix it.
Absolutely. So, hopefully our viewers will hear what we said in the beginning and not end up in the position of having to fix it. They will already be on track.
Right. So, let's talk about how quick your credit score can go up. Kim, how fast can you give your credit score a boost?
I wish I had the magic answer for that. Rod may have that, but from what I've seen, it really depends, because everybody's situation is so different. What caused one credit score to be low could be a completely different factor. What's causing another person's credit score to be low. So unfortunately, I'm going to throw it to you, Rod. I'm sorry about that.
No, I mean, you're absolutely right. There is no quick answer. You're absolutely right. Everybody's unique. If it's a person who's 22 or 23 years old, they have a short credit history. The issues that could be affecting their scores are very different than a person who's been using credit for 30 years. So it all depends on that individual's unique credit history. You can recover, depending on the situation, fairly quickly. So if you've had one late payment, never had any other issues, and you talk to your lender, they might say, yeah, we'll take it off the report, because life does happen. If you have a series of late payments, they're probably not going to agree to do that. It's going to take longer to recover. So it just depends on that individual. That's the answer to every question we have. So Kim and I are done today, right? It depends.
Well, I'm going to get myself in trouble here, so I'm going to bring up some controversial stuff. So put your seatbelts on. I was watching an infomercial. I'm not going to say what it was, but there was somebody that was peddling a book that talked about quick ways to boost your credit score, and they were talking about. And there was also a service that I heard advertised, and I'm not going to say who it was, that was promising to. They were guaranteeing, they said, we can get your credit, we can increase your credit by X amount of points, pay us, we'll do this. What should people know about those services? If I'm out there, I'm hurting, and I hear all that you're saying, which is good advice, but I'm thinking, gee, I don't have the time to go through all those steps. And here's somebody advertising a service that I have to pay for, and then they're going to fix my credit and get it back to normal. I mean, what should I do?
Kim, that's right. That's
exactly. First of all, we must have both been up at 2 a.m. because I myself saw the same thing. Of course, I had to take some medicine for heartburn afterwards, because there is no reason to pay anyone to fix your credits. That is a complete misnomer. That when you have access to your credit report, which, as Rod explained, you do, as you're right, and not only just every 12 months for free, but under numerous circumstances, it really is just, there's no magic bullet. It really is taking what we've said, looking at your payments, making sure you're catching them up, doing what needs to be done, looking at your score, looking at those risk factors, and taking those steps. That's what's going to really do it. I have to tell you, it bothers me when I talk to somebody who has spent a tremendous amount of money on credit repair, when they could have applied that money to some of their past due debt and fixed it themselves.
Yeah, it's the thing I point out is you should know about something called the Credit Repair Organizations Act, the federal law, and know what your rights are. And it says specifically, an organization cannot take a penny from you until they fulfill all of their promises that must be in a written contract. So if they're asking for money up front, they're already breaking the law. And so be aware of that. Know that you can withdraw from that contract. I tell people what the FTC said, that if the Federal Trade Commission says it, it must be true, right? That you can't pay someone to remove back from your credit report. It just doesn't work.
Yeah, that's pretty straightforward. And that kind of, that was the direction I was going to go with. A follow-up question is, what should people look out for? What are the warning signs, like the most clear, most obvious warning signs of a scam, or at least that they're dealing with a company that's not on the level? And that's a good point about, charging the fee up front before they deliver on their promise. And a lot of those promises sound too good to be true. And what I always say is, if it's too good to be true, well, probably is.
If you see got the number from a sign stapled to the light pole by the road, probably not a good sign either.
Yeah.
I see those all the time. Yeah.
It's interesting. When I lived in the Seattle area, I stopped off at the neighborhood grocery store, and there was a pickup truck, an old beat up 1970s pickup truck. And on the back, there was a giant piece of plywood, and it was advertising credit repair out of this beat up pickup truck. And I'm thinking, well, I wonder how many takers they get.
We'd probably be surprised.
Yeah, that's troubling, but true. So Rod, quick question. So we talk about credit and having all these different types of accounts and the factors that go into boosting a credit score. If it's all too complex, why don't I just not have any credit? Why don't I just be completely debt free? Can that get me a top credit score as well?
With no credit, you have no score. So it doesn't help you at all. Credit's a financial tool. Debt's the financial problem. And that's what we always want to help people understand. And at Experian, that's what we always are trying to help people understand, that we want to help you understand how to use credit so that you can become more financially successful and understand that debt is the problem. So, if you're managing your credit well, you'll be able to have access to services that you otherwise couldn't. Not many of us can buy a house if we don't have credit. We don't have that kind of cash. Not many people have $100 or $200 or $300 or $500,000 if you live in California to buy a house. So that credit can work for you. You can't rent a car without presenting a credit card. It doesn't mean you have to pay for it with credit, but you need that credit history to have the credit card to be able to reserve that rental car, for example. So credit's a tool that you can use, and we want people to see it that way.
Mm-hmm. Kim, any thoughts on that?
No, I agree. People automatically assume that because I work in credit counseling and financial education, that I automatically assume debt is bad and that credit is evil. But the reality of it is that used wisely, it really is a tool that most adult Americans need in order to get by. Like I mentioned earlier, the cost of cars, Rod mentioned the cost of homes. Everything is so high right now that without credit, we won't have access to things that we need, such as basic shelter and transportation.
Yeah. And go ahead, Rod.
It can save you money. I mean, we talked a little bit earlier about when you're signing up for utility service. If you don't have credit, you'll likely have to pay a higher service installation fee. If you are getting a cell phone, you're probably going to have to pay a higher rate to get that phone. You're not going to get the discount rate or qualify for that new phone at the lower rate. So it saves you money in the long term. You get cash back, you can get airline miles, you can do all sorts of things that you pay lower interest rates than you otherwise would have to get a loan. So really it can save you money if you use it well.
Mm-hmm. Yeah, and it's about using the right tool the right way for the right job too. Just you mentioned credit. Credit is a tool. You don't use a screwdriver as a hammer, so you need to use it properly. And if you use it properly, it'll take care of you, and it'll get you all those things that you were talking about. Interesting, though. I want to follow up real quickly. So, if I have a bad credit score, and you were talking about utilities. Can I be denied access to a utility, a basic utility, because of my low credit score?
For me or Kim?
Oh, either.
Kim?
But what I've seen is, matter of fact, I just had a situation with someone where they the deposit was too large for the person to be able to pay. So theoretically, were they denied? Not if they could come up with the $500 deposit, but as a result, they unfortunately did not get the apartment because they could not prove that they could have the utility in order to move in to get the CO. So that's something that I know I'm seeing on my side.
Mm-hmm. Yeah, that stakes are pretty high in that situation because it's the roof over your head. You're trying to get a place to live. So just all the more reason to have a healthy credit score.
Yeah, and generally, what I've seen, if you're already you have that service with the winter coming, generally I see city ordinances or state ordinances laws that prohibit cutting off utilities in a situation like that too. So, I think generally they're not going to cut off utilities once it's established, but getting established initially might be an issue. Yeah.
Okay. I want to pivot a little bit. And I know this is sort of an additional question going back to the different scoring models, but it's something that's topical because I've heard this question from a number of different people. You hear about these new iterations of credit scoring models. I'm just using FICO as an example, but there's FICO 7, there's FICO 8, there's FICO 9. Can you walk me through a little bit about what this means to the average consumer when they get their credit score? Are the differences so significant between 6 and 7 or 8? What should they be thinking about in terms of that?
Generally, no. I mean, you're not going to see huge differences. You're not going to see FICO. You're not going to have a FICO 8 score and go to another lender, get a FICO 9 score, and go from a poor score to a great score. You might see some small differences, but it wouldn't make any sense if FICO changed their scores and a person who would in no way qualify before suddenly does. It just doesn't make logical sense, right? So you might see some improvement. The changes, though, are really in how they're working overall for the marketplace and the ability for lenders to more closely identify within groups people who would qualify. So we're seeing some new developments, things like trended data that looks at how you're using credit over time, and lenders use that being incorporated into scores. And what that will do is help if someone's close to qualifying or in kind of a prime or close to prime, and the lender says, well, you wouldn't qualify, but we can look at trended data that shows you are improving in the way you're paying, or your payments over time look good, even though you've had some small issues, might qualify anyway. So it might help you qualify. The way they're treating collection accounts is a little different. So if you pay off a collection account with the newest systems, newest scores, it won't be included anymore in this calculation. So you could see your scores go up. But if a person has collection accounts, they usually have other issues as well. So you tend not to see huge improvement over large percentages of the population. So it might affect some people, but for most people, you're not going to see huge differences.
And one of the recent changes has something to do with a very unfortunate event that's unfolding in the news right now. I understand for people who live in an area that's been declared a federal disaster area, that there have been some exceptions in terms of reporting late payments and how creditors are dealing with those people. Can you expand on that?
Yeah, so the Credit Data, Consumer Data Industry Association, I'll get it right, our trade association for my industry, CDIA, actually has worked with us in the industry, and there's a code that they can put on a person's credit report, essentially, in our systems when they live in an area that's been declared a disaster area. And that helps lenders take appropriate steps to protect them, because they know that with the hurricane coming, that Florence, I think is her name this time, people will be affected by that. And the last thing they need to be worried about is their credit reports and credit scores. And so actually industry takes some steps to help protect people in that way and respond to those needs.
Okay. And that's good for anybody right now who's watching that may be in an area that could be potentially impacted by Hurricane Florence or any of the other hurricanes that are lined up to take aim at the U.S. right now. I think we have 3, 4 in line. It's crazy. Yeah. So good information to know, and people should be proactive in communicating with their creditors ahead of the storms too, just to let them know what's unfolding. So Kim, I want to take the next question to you, and I want to ask you, if somebody who's struggling with their credit, maybe it's because they're behind on their credit card payments, or they're running into a situation where they're facing a number of financial challenges, where can they go for help?
Oh, well, that's a loaded question. They would call me, of course. One of the great things is that we do have agencies like Navicore Solutions and the other agencies that are part of the NFCC. And what it does is these agencies are able to provide people with answers. So if you are running behind on debt and you don't know what to do or where to go, you can contact agencies like ours. One of the things Rod had just mentioned too, being proactive, talking to your creditors is critical. It's important because you don't know what kind of in-house programs that creditors may be offering to you. Once you've gone 30, 60, 90 into now collections, the likelihood that a creditor themselves is going to be able to work with you directly, of course, becomes much less. But if you can talk to them early on in the game, you may find them to work with you much better. And then again, like I said, you could always reach out to nonprofit credit counseling agencies to give you the guidance and advice as well.
Okay. Yeah, that's good information. One thing I want to remind everybody, though, I just looked at a quick note. So for the viewers who are watching, if you do have questions for any of our experts on the panel, for Kim or for Rod, please go ahead and enter those questions into the chat field on YouTube. As I mentioned earlier in this video stream, as some of you who joined late might have missed it, you can enter your questions at any time. So we're getting some questions coming in, but if there are more out there, and I know there are based on the people who are tuned in, just feel free to ask at any time. But that's a good point, Kim. And I want to pivot over to Rod for the next question. It's a bit of a follow-up on what I just asked you. Do you have any evidence in front of you, Rod, that indicates that credit counseling can impact your credit score, just enrolling in a credit counseling program?
Just the fact that you're enrolled doesn't affect scores directly, right? So accounts can be reported as paid through a counseling program, and that statement, some lenders may take that into account when they look at your credit report, and it can be positive because you've shown that you're taking steps to change your situation, but it won't affect scores directly. What really affects scores is the payment status. So are you catching up on those late payments? Are you reducing your balances? And that typically is a result of working with a good credit counselor. And they're going to help you understand how to budget better, how to make those payments, how to manage credit. So in the end, yes, I think we can say that it does help and see that it does help. From a score standpoint, typically we don't see, just being in a counseling program doesn't immediately affect scores or directly, but it certainly over time does.
And I would actually add to what you just said, there's a great study that was conducted by the Ohio State University, independent researchers from the Ohio State University. They looked into the results that were achieved by people who went through the Sharpen Your Financial Focus program, which is a part of what NFCC member agencies like Navicore, they offer to people who are looking for financial counseling. And it actually measured the lift in credit scores over time for the people who went through that coaching process in comparison to people who did not go through. And there was a difference in the lift in credit scores for the people that did get help from an NFCC member agency through that Sharpen Your Financial Focus program versus the control group that did not. So yeah, you can say that over time, if you do the right things and you maintain the payments on time through your repayment program after going to credit counseling, that there will be an organic net positive impact. But what you said initially is that just the fact that you're enrolled in a credit counseling program by itself doesn't have any impact on the score. Okay. Anything you want to add to that, Kim?
I think that one of the key things about being involved with credit counseling agency too is the education that you do receive as well. It's wonderful that making your payments on time is going to bring that score up, but you're also getting financial education that can potentially prevent any problems in the future. Mm-hmm. Being a financial educator myself, I really do feel that by having that level of education to give out, it lets people know what to do to prevent these mistakes from happening again. Mm-hmm. And that can make what a 5-year plan of repayment turn into a lifetime of being in good credit standing.
Yeah, that's a good point. That's a very good point. I do have some questions that are coming in over YouTube, so I'll go ahead and start with some of the questions from our viewers. The first one is really good. It's about somebody who is a homeowner, and they're asking if refinancing their home will hurt their credit score.
I take it that's for me. It depends. Always bail to that. No, when you refinance your home, if as a result of that refinance, they're paying that original mortgage debt in full, so it will be reported as paid, and then opening a new mortgage account, so you would see that new mortgage account reported. That would then be the active account. So you likely wouldn't see any lasting negative effect. You might see an initial dip just because there's such a big change. With a mortgage, huge loan, and so you're paying off one huge loan and you're opening a new huge loan, you might see your scores dip a little. So give it a couple of months to make sure everything's stabilized before you check, and you don't get too excited, but you should see it come back up. And as long as you're paying that new mortgage on time, it's going to help that score improve over time. So time is, you hear us say that word a lot. Time is really a key factor in scores.
Yeah. In every instance. Yeah, that is so true. That is so true. I have another question that came in from one of our YouTube viewers, and they're asking, and this kind of touches on something that we said earlier, but if they tuned in late, they might have missed it. But what is the best way to improve my credit score?
We said it earlier, and and it really is our mantra, I think, in a lot of ways. On time monthly payments. Take a look at the credit report, see where you're standing at that point. Is your score low because you have delinquencies? Get those accounts caught up. If you have used a considerable amount of credit towards your credit limit, pay those debts down, and you will start to see an increase.
Mm-hmm. What are some things, and I'm just kind of following on this question, because what are some things out there that people think they might do to help their credit, but actually would end up hurting their credit? So are there some myths out there about improving credit that might send people the other way?
One pops to mind. Doesn't necessarily hurt your credit, but could cost you money. There's a myth that's been going around for 2 or 3 years now that you should only pay 95% of your balance on your credit card or it will hurt your credit score. Not true. The only thing you'll do is pay interest on that 5% that's left from a credit score standpoint. So if you can pay the balance in full, that's the best thing to do. It's not going to hurt your credit score. In fact, it will help to lower your balances, the better. Don't leave a balance. I hear that a lot for some reason.
Interesting. Yeah. Any other misdirected advice that you can think of?
How much time do we have? Another one I've heard is people confuse that 30% thing. So they think that's a target. And so they charge up to 30% and think that's going to help their score, when in fact it doesn't. It actually increases their balances. So lower the better. I've heard people say you have to make charges up to the limit and then pay them off in full. Don't have to do that. And all you do is end up with a lot of debt that you're paying back each month. So
let's revisit that 30% thing, because I got barked at by somebody for using that figure, and they said, oh, you just pulled that out of the air. There's nothing backing that up. But there is something that's actually backing that up, isn't there?
Yeah, FICO and Vantage score. They both say that. Every credit scoring company I've talked to, that's sort of that, I compare it to when you're buying a diamond and you get to a carat. For some reason, the price you can get to like 0.99 carat and it's cheaper. And then you hit a full carat and it goes up like huge amounts. Your score kind of does the same thing at that 30% ratio. And so if you get to 30% utilization rate at 29%, it's having a negative effect. When you hit 30%, it's a significantly greater effect, because they've shown when a person gets to that level, there's a much higher likelihood, and that's what the math has shown. So FICO and Vantage Score both have said that you never want your balances to be more than 30% of your credit limits.
Okay. Well, here's a conundrum. Let's say that I'm worried about pushing higher than that 30% utilization ratio, and I have two choices. I can pay down the debt and get it under control, or I can open up more lines of credit so that percentage shrinks. Kim, what should I do?
When we were talking about myths, that was one of the ones that I was going to, that was the one that was on the tip of my tongue, because that's the one I hear a lot. But, you know, if I have 5 more credit cards or whatever, no, pay down the debt. Don't access more available credit in an effort to drive that number down. Pay it down.
Okay. Good advice.
And it's good. And Kim's exactly right. As soon as you said, there's a myth we should have hit, because that's a huge one.
Yep.
And what people find is you've applied for a lot of new credit all at once. That's a sign of risk. You have a bunch of new accounts that are now opening. That's another sign of risk. You have a lot of available credit that isn't used yet. It's not clear what you're going to do. And you already have high balances on your other cards. That's a sign of risk. So what you may end up doing is pushing your scores down rather than helping them. So it's always better to pay down the debt if you can.
Okay. Well, I got a few more questions here from YouTube. So we'll do like a shotgun round and a little rapid fire questioning here. But the first one is, does canceling a credit card hurt my credit?
Temporarily.
Yeah.
Yeah.
That's going to be my response too.
Yeah.
Okay.
So when you close the card, you lose the available credit limit. It's back to the thing we just talked about, only in reverse. So you lose the available credit limit. Your utilization rate goes up, so it looks like you're higher risk, typically for just a couple of months. And then it's clear you didn't take on debt, so your scores will come back up again. But yeah,
Okay.
it can hurt your scores temporarily.
And another person is asking, so they say they've seen a lot of websites advertising to check your credit score for free, but does it normally cost to check your credit score?
If you as a consumer are just trying to actively check your credit score, if you're going to use FICO or one of those, then yes, you can pay for it. There are times where you can receive it for free under certain circumstances, and I'm sure Rod will be able to tell us that. But there are agencies out there that are offering these free services. That is not your actual credit score. It's kind of like, Rod, you may be able to explain this a little bit better than this.
Well, I mean, they are. I mean, there are some famous ones that actually use Vantage Score. You can get FICO scores. They're the same scores that lenders would use. There are some that are, but they're all educational in that if you get a score, even if you come to Experian, your first thing to understand is a credit score is not part of a credit report. So typically you'll get when you get that free report annually, you won't get a score. You'll need to pay for it. The score is a tool that's in addition to it. In fact, lenders pay extra for scores when they get their credit report. So it's not really different. But they're educational when you get a score from anyone online, in that even though they're from FICO or Vantage Score, they're the same models. When you go to the lender, they might be using one for auto lending, or they might have a custom score, but it's their credit union. Or it could be exactly the same score, but they want to know that they got a current report and your score isn't from 6 months ago. It may not match. They might use a different credit report. So when you get your score online, it's really educational to you. It'll give you a good sense of where you stand. You'll get the risk factors that go with it. You get the credit report. You'll know pretty well where you stand. There's a very high correlation. Just won't be exactly the same number.
Okay. But the key thing to remember there is, don't just go solely on what you see in the score. Look at the details of your credit report, because that is where you can identify ways to improve the number that you're looking at or maintain a healthy credit score.
Absolutely.
Okay. Good. Well, I'm just going to throw one real quick question in there. It's really super easy. I'll start with you, Kim.
Oh, great.
Where can people find out more about Navicore?
Come to our website at navicoresolutions.org. Explanation about all of our benefits and programs right on our website. Go to the NFCC website as well, where you can find information about our organization too.
Great. And Rod, how can people find out more about Experian?
So visit Experian.com. And if you go to Experian.com/consumer education or Experian.com/credit education, both cases, you'll find great free resources on about credit reports and credit scores, our credit advice column. And you can join us on Periscope on Tuesdays and Thursdays. I'm on at 1:30 Central, 2:30 Eastern, just having a live Q&A, and on our credit chats, and on Twitter on Wednesdays, 2:00 Central, 3 Eastern. You can learn more about both of those at Experian.com/credit chat.
Great. Thank you, Rod. And for those of you in the audience who want to find out more about the NFCC, you are very welcome to visit our website, nfcc.org. There are a lot of great resources. There are consumer tips, articles, and you can even get connected with a counselor to talk with you one-on-one about any questions that you might have about repaying your debt or home ownership or any of the topics that we even covered today. So great resources there. Thank you, Rod. Thank you, Kim. And I appreciate both of you being on the webcast this afternoon. And I thank everybody for tuning in and being a part of this. There were great questions that everybody submitted. We do have a winner of the Amazon gift card. I'm just checking right now. The winner is Susan. Please send us an email, Susan, to info@nfcc.org to get your prize. So congratulations. Thanks, everybody, and have a great afternoon.
Great. Thank you so much.
Thank you.
Thanks.